Hello, my friend, and welcome back to Senior Finance Guide. I am really glad you are here with me today. Today we are talking about one of the most important yet most avoided topics in retirement planning: long-term care. How to pay for help when you can no longer do everything yourself. Nursing home and home care assisted living. These expenses can wipe out a lifetime of savings very quickly. In 2026, the average cost of a private nursing home room is over $110,000 per year. In-home care averages $60,000 per year. Medicare does not cover long-term custodial care. Only short-term skilled nursing after a hospital stay. Many seniors and their families are caught off guard. They think Medicare or Medicaid will cover it all. Or they hope they will never need it. But statistics show that 70% of people turning 65 today will need some form of long-term care. The average stay is 3 years. The goal of this video is to help you plan ahead calmly and realistically so you can protect your savings, your independence, and your family from financial ruin. Everything here is based on official 2026 information from medicare.gov, acl.gov, irs.gov, and state insurance departments. No sales pitches. No fear-mongering. Just clear facts and practical steps. Before we start, the usual reminder. This is for educational purposes only. It is not personalized financial, legal, or medical advice. Long-term care rules vary by state and your situation is unique. Please consult a licensed elder law attorney, financial advisor, or insurance professional before making decisions. Always verify the latest information at official government websites. If you have watched our previous videos on Social Security, Medicare taxes, estate planning, and retirement income, you already know how connected everything is. Long-term care is the final piece that can protect everything you have built. Let us walk through it step by step. Grab your coffee. Let us begin. Who pays? Medicare covers only short-term skilled nursing up to 100 days after a 3-day hospital stay. After that, you pay out of pocket, or Medicaid if you qualify, by spending down assets. Long-term care insurance pays if you bought it. Family often steps in unpaid. The biggest risk is not dying quickly. It is living long with high needs. Women especially face longer periods of care. How to start planning? First, assess your current situation. Health, family support, savings, home equity, other income. Then decide how much risk you are willing to take. Some self-insure. Some buy insurance. Most do a combination. Strategy number 1. Buy traditional long-term care insurance if you can qualify and afford it. Traditional policies pay a daily benefit for a set number of years when you need help with 2 or more activities of daily living: bathing, dressing, eating, toileting, transferring continence. In 2026, premiums are lower if you buy in your 50s or early 60s. A 55-year-old might pay $2,500 per year for $200 per day, benefit 3-year coverage with inflation protection. A 65-year-old might pay $4,000 or more for the same. Pros: tax-free benefits. Protects assets. Covers in home care, assisted living, nursing home. Cons: expensive if bought late. Can lose premiums if you never need care. Companies can raise premiums. Harder to qualify with health issues. How to buy wisely. Get quotes from 3 to 5 highly rated companies. Choose inflation protection 5% compound. Benefit period 3 to 5 years. Daily benefit $150 to $250 depending on your area. Work with an independent broker, not captive agent. Source: acl.gov and State Insurance Department 2026 Long-Term Care Insurance Guides. Strategy number 2. Consider hybrid life insurance long-term care policies. These are the most popular option in 2026. You pay a single premium or limited payments. If you never need care, your heirs get a tax-free death benefit. If you do need care, the policy pays long-term care benefits, usually 2 to 5 times the premium amount. Example: you pay $100,000 single premium at age 65. If no care needed, heirs get $150,000 or more. If care needed, you might get $300,000 to $500,000 in benefits tax-free. Pros: no risk of losing premiums. Guaranteed death benefit. Tax-free benefits. Easier to qualify than traditional LTC insurance. Cons: large upfront cost. Money is locked in. Less flexibility. How to choose? Compare several companies. Look for strong ratings. Choose benefit pool 3 to 5 times premium. Add inflation protection if possible. Work with a fiduciary advisor. Source: acl.gov and Insurance Department 2026 Hybrid Policy Reports. Medicaid is the largest payer of long-term care in the United States. It covers nursing home assisted living and some in-home care for those who qualify. In 2026, qualification depends on income and assets. Most states have income limits around $2,500 to $3,000 per month, and asset limits of $2,000 for an individual. For married couples, the community spouse can keep more assets. In 2026, the community spouse resource allowance is about $154,000 plus the home car personal items and one vehicle. Spend down rules allow you to become eligible by spending excess assets on allowable things. Medical bills, home repairs, prepaid funeral, irrevocable burial trust, or paying off debt. Many people think Medicaid is only for the poor. But middle-class families use it after proper planning. The look-back period is 5 years in most states. If you transfer assets for less than fair value within 5 years, you face a penalty period where Medicaid will not pay. How to plan. Work with an elder law attorney who specializes in Medicaid planning. They can help with spousal transfers, trusts, and other legal tools to protect assets legally. Never transfer assets without advice. Mistakes can cause long penalty periods. Source: Medicaid.gov and State Medicaid Agency 2026 Eligibility Rules. Strategy number 4. Self-insure with a dedicated long-term care fund. If you have substantial savings or home equity, you may choose to self-insure. Set aside a bucket of money specifically for potential care costs. In 2026, a good target is $200,000 to $400,000 invested conservatively in bonds, dividend, stocks, or high-yield savings. This can cover 3 to 5 years of average care. Pros: full control. No premiums. Money stays yours or goes to heirs if not used. Cons: market risk, opportunity cost. If care lasts longer than expected, savings can deplete. How to do it right. Calculate realistic costs in your area. Invest the fund conservatively. Review annually. Combine with other strategies like home equity or family help. Source: acl.gov Long-Term Care Cost Estimates 2026. Strategy number 5. Use home equity wisely. Your home is a key asset for long-term care planning. In 2026, you can tap home equity without selling through a reverse mortgage or home equity line of credit. Reverse mortgage can provide monthly payments or a line of credit for care expenses. No monthly payments required. You stay in your home. Pros: access cash without selling. Can pay for in-home care. Cons: reduces equity for heirs. Interest accrues. Fees are high. You must maintain taxes, insurance, and upkeep. How to use wisely. Get HUD counseling. Compare lenders. Use only for legitimate care needs. Consider selling and moving to assisted living if care is extensive. Source: hud.gov Reverse Mortgage and Consumer Finance. Gov Home Equity Options 2026. Strategy number 6. Explore continuing care retirement communities. CCRCs. CCRCs offer a continuum of care. Independent living, assisted living, nursing care, all on one campus. You pay an entrance fee and monthly fees. In 2026, entrance fees range from $100,000 to $1 million depending on location and contract type. Monthly fees $3,000 to $8,000. Pros: guaranteed access to higher care levels. No need to move if needs change. Social community activities. Cons: high upfront cost. Some contracts are non-refundable. If you leave early, you may lose money. How to choose. Visit several. Check financial stability. Understand contract types, refundable modified fee for service. Work with an advisor to model costs. Source: Leading Edge. Org and State Consumer Protection Agencies 2026 CCRC Guides. Strategy number 7. Involve family early and legally. Long-term care planning is a family matter. Talk openly with adult children or trusted relatives about your wishes, preferences, and documents. Appoint a power of attorney for finances and healthcare. Update it every few years. Give copies to family and your doctor. Discuss who will help coordinate care. Who will manage finances. Where you prefer to receive care. Why it matters. Without clear communication, family can disagree during a crisis, leading to stress, guilt, or poor decisions.